The Dow Jones Industrial Average experienced a dramatic plunge on April 4, 2025, plummeting by nearly 1,700 points. This represented a significant drop of approximately 4.5%, marking one of the worst trading days in recent history. The sharp decline sent shockwaves through Wall Street and global financial markets. Investors reacted with a mixture of panic and uncertainty. The market downturn came as a shock to many, who had hoped for a calmer period after weeks of volatility. The sudden drop in the Dow Jones was not an isolated event. It reflected deeper concerns about the global economy and escalating trade tensions between the United States and China. The market had been on edge for weeks, with investors closely monitoring developments in the trade talks. The news of China's retaliatory tariffs, announced earlier in the week, had already created a sense of unease among market participants. This latest escalation in the trade war between the world's two largest economies had a profound impact on market sentiment, triggering a wave of selling pressure. The decline in the Dow Jones was accompanied by similar drops in other major stock indices. The S&P 500, a broader measure of the U.S. stock market, fell by roughly 5%. The tech-heavy Nasdaq Composite Index experienced an even steeper decline, plummeting by over 5%. These synchronized declines across multiple indices highlighted the widespread nature of the market sell-off. This was not just a case of investors pulling back from specific sectors or companies, it was a broader flight from risk assets in general. The market turmoil on April 4, 2025, served as a stark reminder of the interconnectedness of global markets and the potential for geopolitical events to impact investor sentiment. The trade war, with its unpredictable nature and potential for further escalation, had become a significant source of uncertainty for businesses and investors alike. The situation called for a cautious approach as market participants braced themselves for continued volatility in the days and weeks ahead. The trade war between the United States and China escalated significantly, contributing to the sharp decline in the Dow Jones. The trade dispute, which had been simmering for months, reignited with renewed intensity. Both countries had imposed tariffs on billions of dollars worth of each other's goods. This tit-for-tat exchange of tariffs created a climate of uncertainty and disrupted global supply chains. The Trump administration had long accused China of unfair trade practices, including intellectual property theft and forced technology transfer. The U.S. government argued that these practices gave Chinese companies an unfair advantage and harmed American businesses and workers. To address these concerns, the U.S. imposed tariffs on a wide range of Chinese imports, including electronics, machinery, and consumer goods. The goal was to pressure China to make concessions and change its trade practices. China, however, refused to back down and responded with its own tariffs on American goods. The Chinese government viewed the U.S. tariffs as protectionist and harmful to the global trading system. China targeted its tariffs strategically, aiming to inflict pain on key American industries, such as agriculture and manufacturing. The agricultural sector in particular was hit hard, as China was a major buyer of American soybeans and other agricultural products. The escalating trade war had a ripple effect throughout the global economy. Businesses faced higher costs for raw materials and components, cutting into their profits. Consumers also felt the pinch as prices for many goods and services rose. The International Monetary Fund, or IMF, warned that the trade war was a threat to global economic growth. The IMF urged both sides to resolve their differences through dialogue and negotiation, rather than resorting to tariffs and other protectionist measures. Adding to the market's woes were growing fears of a recession in the United States. Economic indicators had been flashing warning signs for months, and the escalating trade war only heightened those concerns. The stock market, often seen as a barometer of the economy's health, reflected this growing unease. Investors began to price in the possibility of a recession, leading to a decline in stock prices. One of the most closely watched indicators was the yield curve, which reflects the difference between short-term and long-term interest rates. Typically, long-term interest rates are higher than short-term rates, reflecting the expectation of economic growth in the future. However, the yield curve had inverted, meaning that short-term rates were higher than long-term rates. An inverted yield curve has historically been a reliable predictor of recessions. Another concerning sign was the slowdown in global economic growth. China, the world's second-largest economy, had been experiencing slower growth for several quarters. Europe, too, was facing economic headwinds, including Brexit uncertainty and political instability in some countries. The slowdown in these major economies had a ripple effect on the rest of the world, including the United States. The trade war exacerbated these economic anxieties. Businesses became more cautious about investing and hiring, uncertain about the future direction of the economy. Consumer confidence also took a hit as people worried about the potential impact of tariffs on prices and jobs. This decline in business and consumer confidence could lead to a self-fulfilling prophecy, further slowing economic growth. The stock market sell-off on April 4, 2025, triggered a wave of reactions from investors, analysts, and policymakers. Investors sought refuge in safe haven assets, such as gold and government bonds. The price of gold, often seen as a safe haven during times of economic uncertainty, surged to its highest level in months. Meanwhile, yields on U.S. Treasury bonds, considered among the safest investments in the world, fell as investors piled into these securities. Financial analysts scrambled to make sense of the market turmoil and provide guidance to their clients. Some analysts viewed the sell-off as an overreaction, arguing that the market had priced in the worst-case scenario. They pointed to the underlying strength of the U.S. economy, with low unemployment and strong consumer spending, as reasons for optimism. Other analysts, however, were more cautious, warning that the trade war and recession fears could have a more prolonged impact on the markets. Amidst the market volatility, policymakers faced growing pressure to take action. The Federal Reserve, the central bank of the United States, had already signaled its willingness to cut interest rates to support the economy if necessary. Some economists argued that the Fed should act sooner rather than later to prevent a recession. Others, however, cautioned against cutting rates too aggressively, arguing that it could fuel inflation without necessarily boosting economic growth. In the corporate world, companies with significant exposure to China were among the hardest hit. Apple, for example, saw its stock price tumble as investors worried about the impact of tariffs on its supply chain and sales in China. Other companies with global supply chains and significant sales in China also faced pressure from investors. On the other hand, companies with a more domestic focus and less reliance on international trade fared relatively better.